Hey everyone, Taylor Welch here from Wealth Cap Holdings. Wanted to give you an overview of our investor analysis. This is a spreadsheet we do on every single property that we're making available to our list of investors. If you're interested in getting any assets from us, you've probably already been sent something that looks a lot like this. I just wanted to go over it for a couple minutes to show you how we put together our investor packages and how we basically pull the returns, both cash on cash, equity paydowns, all of the formulas so far that we've done as a company. So obviously the property information, relatively self-explanatory. It's the property name, the location, the type, size in square foot, and then the estimated comps for the dollar per square foot. This is really important to know because we basically go into a market or we buy a piece of property. We've done comps on probably a dozen comparable houses in that area. So the house next door, the house across the street, the house 2 blocks down, and we basically build a model or an average of what are these houses selling for per square foot. And that gives us a good idea of what the estimated after repair, this ARV after repair value is going to be. And we always try to make sure that we build in some equity for our clients. So obviously, there are turnkey companies and people in the game who are buying a house for, a house will sell for 150 and the equity in the house is 150, and they think that's a great deal. And sure, it's not a bad deal, but we try to make sure that when we're flipping a house to an investor, we're giving them an immediate equity advantage, so that if they're a serious investor, if you're building, if you're acquiring assets as a actual business, you want to grow a portfolio that will produce cash income for you and it will appraise higher than what you paid for it. We are definitely ahead of the pack in doing that because we try to build in about $10,000 or more of free equity on every single deal that we get into an investor's hand. So cost information over here, you got the purchase price. This would obviously be $15,000 in free equity. All of this is subject to appraisals. We get everything third party independently appraised just to make sure that you're not investing in a product that is just based on our investor speculation, where you're investing into a product that has been independently verified as, hey, this is this equity in this house is actually superior to what you are paying for it. So we'll get you all those cost information. There's some formulas in here. Just want to go through them really quickly. Loan to value. You probably already know that your loan to value basically tells you how much of the total purchase price is your loan covering. So this would be a 20% down payment. If the loan to value is 80%, that means that it would be a 20% down payment. 20% of 155 is $31,000, which means you're being left over with a balance of 124. This is variable, so the interest rates, we update these based on the current time and season that we are in economically. So right now the markets are around 3.9% interest. We just put it at 4. 30-year fixed SAM, those are the ones you want to get as an investor if you can swing it. So these formulas in here basically show you what your taxes, your insurance, and then your mortgage payment is going to be. So this is all broken down for you so you can actually go in and you can look at the numbers in the formula. Then expenses down here, just hop down to the second area. You're going to want to get every house probably managed unless you want to manage it yourself, which I don't recommend. The management company will basically collect the rent, collect the late fees if the tenant is late, God forbid. They will take care of maintenance, things like that. Anything that is going to go into the property being profitable for you, they're going to manage all of that. So management fees, we have a really good preferred management company that it's all of the markets that we're operating in. They're also in those markets. They charge $79 a month. Mortgage on this house, again, we're just taking it from up here, which is a formula that is coming from the interest rate, the loan term, and the amortization schedule. The mortgage on this is going to be $591, taxes and insurance around $217, and no HOA for this particular property. And then it's going to give you a total monthly expenses of $888. Now watch what happens if we go up and we change this to 5%. It's going to do all the math for you. The 5% is going to add not quite $100, but about $80 it looks like to the home. So we have preferred lenders that you can talk to just to help you get pre-approved, lock in really good interest rates. But even a 4.5%, that 0.5% difference makes a pretty big swing and the monthly expenses. All right, so those are the expenses. Let's come down to operating income. We give a rent range for all of this. Again, this is not based on just speculation. We go to all of the houses that are comparable in the area. So what is normal rent? How we have connections obviously with our management company, manage thousands and thousands and thousands of deals. So we can actually go see, we get them to put a professional rental income range on all of our deals. So for this particular house, it's $1,350 a month, and that is going to produce a yearly operating income of $16,200. This is just the rent income here multiplied by the full fiscal year. Operating expenses, this is going to basically take these monthly expenses, multiply it by 12 as well. And you're going to get NOI. This is your net operating income. This is a really important number because this is your profit. This is the money that is just sitting in a bank account for you after a year of this machine being able to work for you. And then down here, we have an in-depth analysis of cash flow and ROI. So your cash flow per month is going to be your total rental income minus your expenses. It's going to give you $462 per month. Your annual cash flow is just copied from here, your net operating income. Your cash on cash return, this is an important number because we believe that our philosophy is that everything should be judged based on its ability to pay for itself. You don't want to get into investment opportunities where you're dependent on market appreciation. You don't want to get into deals where the deal only makes sense if the debt pay down is there for equity. I think it's a bad way to do business if you are dependent on a market appreciating. It's just not good. You can't predict that. Nobody knows what's going to happen in all of the markets. You don't want to depend on appreciation. You don't want to depend on anything else to make a deal make sense besides its ability to produce income. It's just like a business. Treat your real estate as if it were a business because nobody's investing into a business based on its ability to appreciate. Everybody wants to know where the money is. Is this business paying for itself? Is this house paying for itself? Are you going to get an asset that is fully paid for? And by the way, it's made you a great income over the next 20, 30, 40 years. And so this cash on cash gives you really a great way of looking at a deal to whether it makes sense. 17% cash on cash. All we're doing with this is we're taking the monthly cash flow, multiplying it by 12, dividing it by the amount of money you have in the deal. So 17.8% is a very good return. The equity pay down on this deal is formulated from another equation. This is basically how much of your mortgage is being paid down every year by the tenant. You have principal and you have interest and you've got taxes inside of this monthly expense. So this formula tells you, hey, every year you're going to get $2,100 of free equity. A tenant is actually going to pay down $2,100 a year of this mortgage. It's a 30-year. 30 years from now, this house is going to be totally paid for. You didn't pay anything for it, and it's going to produce $5,000 a year, $5,500 a year of income for you. That cash plus equity brings the equity up to 24.8%. A lot of companies are going to factor in this equity ROI into your cash on cash, but we don't do that either because, again, if the house is not producing cash, money, the ability to go out and buy you can't go out and buy new houses with equity or debt pay down. Can't do that. Your bank's going to say, well, where's the money? Where's the cash? So you need to make really the decision based on this figure right here. Is this figure, cash on cash, a good figure? And if the figure makes sense, then everything else is bonus. This equity, it's all bonus. The appreciation, it's all bonus. We don't even build appreciation into our model. Every deal we go into, we require it to have a historical average appreciation of 2%. But again, I just don't think it's a huge, it should not be the main thing you're making decisions on. And then you've got a synopsis over here. Here's the cash on cash return. Here's the monthly cash flow, monthly debt pay down, and then your money recouped. This is actually really important because I've set a goal for all of our deals to pay for themselves within 5 years. If you are a long-term investor, you know how rare this is. Because people will get into deals these days that are 3, 4, 5 caps. They're not going to pay for themselves for 10, 11 years. And if you can recoup your investment in 4 years, it allows you to do some interesting strategies. 4 or 5 years, actually the law is you want to at least be under 7. If you can be under 7 years, you're typically in a pretty good investment vehicle. This particular house is 4. This is an amazing piece of property, and this is something I would buy for myself. I routinely do buy for myself all the time. So we'll send whatever you're looking at buying. We have an investor analysis package put together already. If you have any questions, just reach out and let us know. We have 4, 5, 6 of these deals a month that are hitting the markets. They're usually gone and under purchase contracts within, hard to actually believe, within 1 to 2 days of them becoming available, just because the deals are good. It's very difficult to find a company who can do this and who has the buffer and the hedging built in to really make sure that what you see on this paper is actually what you're going to get when you own the property. So if you have any questions, reach out, let us know. This is what we do, and can't wait to help you build an empire for yourself and your family and help you hit your long-term wealth goals. Talk soon.